Hi guys, this is CR Jane and welcome back to my YouTube channel ACCA and Beyond. And in today's video, we are going to continue the FR series. And today's chapter is going to be chapter number 3, which is Intangible Assets. So let's quickly get started. Okay, so an intangible asset is an identifiable non-monetary asset without physical substance. This means an intangible asset is an asset that has uh, no physical form but still has value and can help business earn money. I'm hoping we are clear with the definition. So some of the examples are license and quotas, intellectual properties, that is your patents and copyrights, your brand names and your trademarks. So when is something an intangible asset? um, to fit into IAS 38 intangible asset criteria, the asset has to fit into one of these two categories, which is first, it should be separable. It can be sold, transferred, licensed, or rented separately from the rest of the business. Example, a patent can be sold to another company, so that is separable. You can just take it apart from your business. And second, it should arise from legal or contractual rights. That means it exists because of a legal agreement with someone or law, and even if it cannot be sold separately. So even if you cannot sell it separately, for example, you have a broadcasting license for or a franchise agreement with someone, you cannot sell that to anyone else, but it arises from a legal agreement with someone. And it must yes, so it has to fit one of these two categories, but it also has to meet the normal definition of an asset, which is it should be controlled by the business. The business has the legal right to use it and stops others from using it. And at there we are certain that it is expected that to generate future benefits, such as more revenue or cost savings. Okay, so in order to recognize intangible assets in the financial statements, it must meet the definition of an intangible asset, which we discussed over here, and the recognition criteria, which is given in the framework, that future economic benefits are going to flow to the entity, and the cost of the asset can be reliably measured. So this is an important point, because if you cannot measure the cost of your asset, like the cost of an intangible asset, if you have a patent to something, and you cannot measure it reliably, you cannot recognize it as an intangible asset, and that would go into your goodwill. So we don't want that, so we want to measure it reliably. And if you meet all of these following criteria, then you can recognize the asset at cost. So this is important. This is your initial recognition. Okay, now if you have purchased an intangible asset, such as you can purchase a license, patent, or a brand name, this again should be recognized at cost. This is again your initial recognition. Now after your initial recognition, just like normal assets, we again over here have two choices. We can choose to value it at the cost model or the revaluation model. We discussed this in the earlier chapters, but I'm going to discuss just revise it again. So in the cost model, the intangible asset should be carried at cost less amortization and any impairment loss. So amortization is nothing but your depreciation. For intangible assets, we say it as amortization, but it's the same thing, nothing changes, it's just depreciation. And any impairment loss, if any, you have to subtract that from the cost of the asset, and any depreciation. So this is just very simple. This is your cost model, and this model is more commonly used in practice because it is way simpler. And amortization works the same way as depreciation. I already told you guys. The intangible asset is amortized over the useful life, with the annual expense being shown in the statement of profit or loss each year. So same as depreciation, we depreciate over the useful life. Again, we have to amortize over the useful life, and the expense is shown in the profit or loss. An intangible asset with a finite useful life must be amortized over that life. normally using the straight line method with a zero residual value. So let's say your asset is worth 100 and you have a 5-year life, which gives us 20. So yeah, so you have to subtract 20 from it every year, and eventually when you subtract 20 you get 0 as a residual value. And if this is for when we have finite useful life, when we can measure when this the value of this asset is going to get over, when we can measure like the patent is only for 5 years or 10 years. So after that we the value of that asset is going to be 0, so the useful life is 5 years or 10 years. An intangible asset with an indefinite useful life should not be amortized, should be tested for impairment annually and more often if there is an actual indication of possible impairment. So there are many assets, intangible assets especially, where we do not know the useful when it's going to end. There are some patents which you have bought for long lifelong also, or some license also. So for that we do not depreciate it because there is no useful life. We just check it for impairment regularly, and yeah, if there is an impairment we just expense it off to profit and loss. Now let's talk about the revaluation model. The intangible asset may be revalued to a carrying amount of fair value less subsequent amortization and impairment losses. So this is very simple. Like we discussed earlier, we have to revalue it every year. Let's say we bought it for 50 rupees a patent. Now the value is, let's say, 75. So this is our fair value right now for this year. And let's say next year it got impaired and now the value is 60. So our impairment loss was 15 rupees. And fair value should be determined by reference to an active market. So this is very easy. How can you determine a fair value of a product if you don't have an active market? Let's say I bought a computer for 50 rupees. After that they stopped selling that computer, stopped making that computer, and now I don't know how much it values because there's no one willing to sell it, no one willing to buy it. So there's no way of me finding out how to price my computer. So it's very important to have an active market to find out fair value of a product. An active market is a market in which transaction for the asset take place with sufficient frequency and volume to provide pricing information on an ongoing basis. So this is the same thing. An active market is where the product is being sold or bought in frequency and in volume, so that we can find out the price information. IAS 38 states that the active market for intangible assets are rare and specifically prohibits the revaluation of patents, brand names, trademarks, and publishing rights. It's very easy. Let's say you are in the manufacturing business and you bought a patent of a certain type of manufacturing style. So it's not very usual that these types of patent have an active market. So that's why revaluing of these patents or these brand names, let's say you have a brand in very distinct industry, let's say you have a book manufacturing is actually quite common. Let's say there's some company which is not that which is not many people are doing it. So that type of brand names, they are very hard to value what's their fair value. So generally IAS 38 prohibits from using revaluation model for intangible assets and tells us to use a cost model. But yeah, some people still use it. So as a guide, indicators of an active market would be the items traded within the market are homogeneous and the prices are available to the public. So it should so the indicators of the active market are that the market should be homogeneous, identical. So if you are finding out the fair value of a patent, it just doesn't mean you can find out the fair value of any patent. Maybe you have to find out the fair value of a certain manufacturing style, but you are searching for the value of a patent of something in a very different field. So you obviously cannot use that fair value in your manufacturing business. And the prices should be known to the public also. You cannot just value it, नहीं मेरे को तो लगता है इसका 50,000 value होगा इसलिए I am going to value it at 50,000. You cannot do that. It should be public knowledge, the value of these patents or trademarks or anything. So most intangible assets have value because of the uniqueness and are therefore unlikely to be homogeneous. So patents are something which you have copyright. Patents are similar to copyright. I am not sure, but yeah, something if you have patented it, no one else can use. So it is very unlikely, right? If not even unlikely, no one else can use it. That's the actual meaning of a patent, that no one else can use my technique. So how are you going to find out the fair value of that technique then? Certain license may fit this model and could possibly be revalued, but most of other intangible assets will not. So, license, maybe they are a little bit easier to find out the fair value, but Overall, most of the intangible assets is very hard to find out the fair value. Now let's talk about internally generated intangible assets. So internally generated intangible assets are something which you have created on your own in your own company. Like you have made a goodwill for your own company. Like we have made a business for, like we have made a business for 50 years. So the goodwill for that 50 years is something which you have made on your own, and now you cannot measure that goodwill, right? So, and maybe you made an inbuilt a brand, you made a brand inside your company, or some publishing titles you which you have made on your own, or maybe some customer or supplier list you have. So these are something which you have made on your own. These cannot be identified separately from your business. Just one second. So yeah, what I was talking about, something which you have created in your own company, and something you have created inside your own company, it's very hard to measure. So because you cannot separately identify these costs, like how do you know how much is my goodwill? It's just your brand's reputation, right? How do you know how much is your customer list going to value? It's just a list of all of your customers or your supplier list. So yeah, these are internally generated intangible assets. So so a brand created by the company itself, that is through advertising or marketing, cannot be recognized as an intangible asset. Why? Because it is impossible to separate the cost of creating the brand from the overall cost of running and growing the business. So the accounting treatment would be just to expense it to P&L. Uh, Maybe for example, Coca-Cola spends millions on advertising to strengthen its brand. The advertising cost is expensed, not recorded as an intangible asset. Now, if a brand name is bought from another company and its cost can be reliably measured, then it can be recognized as an intangible asset. And the accounting treatment is to recognize it as an intangible asset under IAS 38, because you have bought this brand, right? So you have paid money for it, you have paid some consideration for it, so you know how much it values. That's why you can record it. um yeah, so this was it. Let's talk about this little illustration. So how should the following intangible assets be treated in the financial statements? A publishing title acquired as part of a subsidiary company. So now this publishing title you have acquired with the subsidiary company, right? This was one whole product, not two separate products. So you cannot reliably measure the value of the publishing title unless you have an active market, which is not fairly possible, because we talked about it earlier also. So I would say it needs to be taken as part of your goodwill. Let's read the answer. So the answer depends on whether the asset can be valued reliably. If it is possible, the title will be recognized as its fair value. Otherwise, it will be treated as part of goodwill on the acquisition of the subsidiary. So yeah, if you have an active market, you can value it fair value, but it's very highly unlikely you will have a fair market. So it should be treated as part of goodwill. Now the license, a license purchased in order to market a new product. So you have purchased it, right? You have paid some consideration, some money for it, so you can value it reliably, so you can recognize it under IAS 38. As a license can be purchased separately from a business, it should be initially capitalized at cost. Yes, so because we have paid something for it, we can measure it. Now let's talk about goodwill. So, the niche of goodwill. Goodwill is a difference between the value of a business as a whole and the aggregate of the fair values of the separable net assets. So, I'm not sure. I'll first give an example. So, let's say we are buying a company for 100 rupees, but the value of its net assets, all of its receivables, all of its assets, the machineries and everything, summing all of it up and cutting off your liabilities from it. So your net assets, that's your net assets. Okay, so assets is assets minus liability. So the value of your net assets is just 80 rupees, but still we are paying more extra 20 rupees for it. Why? Because the company has some brand values, company has some that brand name has some reputation to it. Let's say if you are buying McDonald's, people are generally more trustable towards these brands, McDonald's, Domino's, or maybe Adidas or Coca-Cola. These brands these brands, they have some name of some value to their name, so that 20 rupees extra what you are paying is for your goodwill. So, separable net assets are those assets and liabilities that can be identified and sold off separately without necessarily disposing of the business as a whole. They include identifiable intangible assets such as patents, license, and trademarks. So, if these patents, license, and trademarks, they are separable, like we talked about earlier, and they can be reliably measured, then we can identify it as an intangible asset. Fair value is defined in IFRS 13 as a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction market participants at the measurement date. So, fair value is something, let's say, if you bought a building at 80 rupees in the past, but today's its value is just 50 rupees. If you want to sell it in the market because it's just what you are receiving is just 50 rupees, then that's the fair value of the company. Goodwill may exist because of any combination of number of possible factors: reputation for quality of service, technical expertise, possession of favorable contracts, good management and staff. Yeah, so these are all the factors for goodwill. That is, your brand has some reputation to it. There is you are providing very good customer service or technical expertise. You have very big contracts to your name. Let's say a company is just has a net assets of just 100 rupees, but you have signed some deals with some suppliers or something, or maybe with customers, which is worth, let's say, 50 rupees in the future. So you're not going to sell your company for 100 rupees right now, right? Because that would be a loss, because you know that 50 rupees is guaranteed that you're going to receive in the future. So the wise decision would be to sell it at 150. So that's your goodwill, right? So that 50 rupees which you're going to sell extra for is your goodwill. Now purchase and non-purchased goodwill. How long is this chapter? Let me just see. Okay. So, purchase goodwill arises when one business acquires another as a going concern, includes goodwill arising on consolidation of a subsidiary, and will be recognized in the financial statement as its value at a particular point in time is certain. So, when you have purchased a goodwill, when you have bought another company, and maybe when you're consolidating your financial statements with a subsidiary, you can recognize the goodwill in your financial statements too, because these goodwill can be reliably measured, because the net assets of that company is worth just 80 rupees, but anyways you're still paying 100 rupees. Why am I paying extra? Because I know that 20 rupees difference is what I'm paying for my goodwill. So that goodwill can be measured and can be recognized in a financial statement. And the non-purchase goodwill is also known as inherent goodwill, has no identifiable value, is not recognized in the financial statements. So maybe if I had not bought the company, let's say I'm this company. First, I was looking at from the perspective of this B company, which was going to buy the A company for 100 rupees. But let's say now I'm A company, I'm standing at 80 rupees. I know my net assets is 80 rupees, but I don't know any like let's say I have not made a survey. I do not know the fair value of my company, so I cannot reliably measure the goodwill of my company. So that's why this goodwill cannot be recognized in the financial statements. IFRS 3 business. How long is this? IFRS 3 business combination. IFRS 3 governs accounting for all business combinations and deals with the accounting treatment for goodwill. Goodwill is defined as an asset representing the future economic benefits arising from assets acquired in a business combination that are not individually identified and separately recognized. So this is again simple, and goodwill is something which is your brand value, which tells you that you are going to receive money in the future, but you cannot identify it individually and separately recognize it in your financial statement. Now, this what we talked about over here was your positive goodwill. You were paying extra to buy a certain company. One second. To buy a certain company, but there can be negative goodwill also. When my net assets is worth 100 rupees, but I am only going to receive 80 rupees when someone wants to buy my company, this 20 rupees is going to be my loss. There are many reasons which can be done for it. Maybe your company was loss making and no one else was willing to buy it, so you have to sell your company at a bargain. So that is your 20 rupees as a negative goodwill. That's what we call as a negative goodwill. Okay, So accounting for non-purchased goodwill should not be recognized in the financial statements. It certainly exists, but fails to satisfy the recognition criteria in the framework. So since it is not capable of being measured reliably. So because you cannot measure reliably your goodwill, or because all of the factors we talked about above over, so again you cannot measure internally generated goodwill in your financial statements. So for this video I'm going to stop over here because I have a problem. If I record for more than 30 minutes, my video starts to lag and it doesn't get uploaded swiftly. So for this video I'm going to stop over here, and if you have any doubts, if you want any help, please feel free to reach out in the comment section. And if you found this video helpful, please share it with your friends, like and subscribe to my channel. It would be really helpful. And thank you so much for watching. I'll see you guys in the next video.